Good day, fellow investors. Now, what has Buffett been buying last quarter? Apple and Apple stock, and a lot of it. Apple is now his biggest position, his biggest portfolio position, making 14.6% of his stock holdings. So I really want to see why Buffett is buying Apple, and I think I have a very different perspective than most analysts have on Apple, because Buffett is looking for a 10% return on investment, while Apple has now a price to earnings ratio of 18, which is just north of 5%. So it means that Buffett sees much more potential in Apple, and that's why he is buying the stock. Let's see. According to some surveys, JP Morgan, 92% of iPhone customers will buy another iPhone, while a Comcast survey indicated a 96% retention rate. So when you put that on the 1.3 billion devices, then you have an ecosystem of loyal customers. And that's what Buffett is looking for, because he's always looking for a moat, investing in a moat. What will Apple do with those 1.3 billion customers, growing customer base? They will increase the services, they will grow Apple Pay. Apple Pay is now available in more than 50% of merchants in North America. So if they can increase that further, we will stop walking around with our wallets and we will just walk around with our phone. So that's perhaps the future that Buffett sees. In the meantime, he gets a nice dividend plus a lot of returns from buybacks, which I'll show you later in the model how that can affect Apple's stock price and why Buffett is buying Apple. Remember, Buffett and Munger said that their long-term aim for return for Berkshire is 10% now. So he thinks Buffett is still cheap and will deliver a 10% or higher return in the long term. Apple's services revenue was up 18% last year, and they are on schedule to doubling their 2016 services revenue by 2020. If they continue on that pace up to 2027, services might be the biggest component of Apple's revenue. So services, Apple Pay, everybody will walk around with their piece of hardware, a phone that their whole life will be on it. So perhaps Buffett is saying, okay, this is another American Express. People will simply use their phone to pay, to do whatever, to do all the transactions. So I better be invested in something like that. Plus the yield now is not that bad and there is a lot of cash. Second thing that he wants after a moat is a great return on invested capital, and Apple has a net profit margin of 21%. That's one of the best returns on invested capital out there. So if I put everything in a model, we go from net income of 48.35 billion in 2017, and we make that net income grow at 10% over the next 10 years, we come to 125 billion of net income in 2027. If Apple continues to buy back 3% of the number of shares outstanding over the next 10 years, the number of shares outstanding will go from the current 5.25 billion to 3.87 billion, which means that earnings per share, if that happens, will go from the current $9.21 end of Q4 for Apple 2017 to $32.39. If we add a price earnings ratio of 20 onto that, we get to a stock price of 640 and a market capitalization of 2.5 trillion. So that is what Buffett is buying now. If it doesn't happen, he will get his dividends, he will probably get a good return on investment. However, the potential is there to get a great return on investment. Apart from Apple Pay, there is the augmented reality, a lot of things that go around and evolve around Apple's ecosystem of 1.3 billion highly paying customers, because they paid a lot for that iPhone. Now, something very important. If I look at what analysts have been asking the management in the last conference call, it is mostly short term. It all evolves around the capital structure, iPhone demand and pricing, the 1000 iPhone 10 or iPhone X versus cheaper products, March quarter guidance, weaker dollar, iPhone replacement cycle that is getting longer, tax rate, HomePod, trends in China, net cash. Only Mike Olson from Piper Jaffray was asking about future products and how the management sees augmented reality fit Apple's future. So only one analyst asks a long-term view, only one analyst has a long-term view on what's going on, or at least asks a question about that. However, the key with Apple, I think, is the long-term view, not the focus on the next quarter, March guidance, or on the next iPhone cycle. The focus, if you're really an investor, you're focusing on the ecosystem Apple is building, and that will last for the next 10-20 years, as it has been the case for the past 41 years since Apple has been founded. I also want to compare Apple to others. So the customer base, Apple 1.2 billion, Microsoft 1.2 billion, Google 2 billion, Amazon 250 million, Facebook 1.4 billion, Netflix 100 million. The price to earnings ratio is the lower with Apple, which means the company is already profitable and it's monetizing hardware sales, not even services yet. So there is a huge margin for improvement. Microsoft much higher, Google much higher, Amazon much higher price to earnings ratio. Also the market caps are there. Netflix's is much lower, but also market caps aren't much away from Apple's, but Apple's is the most profitable of all those companies. So from that perspective, from a customer base to earnings, Apple is the cheapest of the bunch. So if you're looking for a good long-term investment that will give you above 10% over the very long term, buy Apple, reinvest the dividends, and you will do probably very fine over the very long term. And that's why Buffett is buying Apple.